Thank you, Tim, and thank you to Share Cafe for the opportunity to talk about the business today. Just by way of quick introduction, something we're really quite proud of in our business is we do have a legacy going back 100 years with the two family companies that were the backbone of Silk Contract Logistics. That business was acquired via an MBO by myself and my business partner and some other shareholders in 2014. And through a variety of shareholder changes and capital raises, we took that business as Silk Logistics Holdings to an IPO in July of this year. In terms of the business, Tim touched on in terms of what we do, and if we just look at that next slide, Tim, there's a couple of critical points I'd like to draw attention to here. We describe ourselves as a technology-enabled port-to-door logistics provider. And one of the key lines here is we are asset light. Daniel touched on some of those challenges confronting supply chains and the logistics industry generally. Our view is the business model that we're bringing to market is really standing up well under some of those pressures. If you look at the business, you can see there we have that physical supply chain that we service. We do own some fleet in the wharf cartage, but it is generally very specialised fleet that we can get a 24/7 utilisation out of. Other than that, our warehousing operations are all leased, and our distribution network is a virtual network of 60-odd carriers across the country. That physical supply chain is then mapped into what we think is really a unique proposition, and that is we use a control tower platform that Silk has the exclusive rights to here as a 3PL operator in Australia called One Network. And effectively, anywhere our customer product sits within that supply chain, we can provide our customers visibility of where their product sits. It's a unique part of what we do, along with that asset-light operating model that we've talked to. Thanks, Tim. Just in terms of the business overview, these are some numbers from FY21. Strong revenues and growth from prior years. And really, FY21 for us was the culmination of 2 to 3 years of hard work of acquisitions and bringing the business together. And we've really now laid a very, very strong platform for ongoing growth. And really the purpose of coming to market in terms of listing our business was really to give ourselves access to that next level of capital to take advantage of what remains a highly fragmented market that we operate in across those service lanes that we described earlier. Just some quick highlights: revenue growth, year on year of 28%. We've had a 7-year average CAGR of 19% since we completed the MBO in 14. And certainly, despite some challenges in 22 as listed by Daniel, we're certainly seeing some good pull-through of the new business that we generated last year, and we're continuing to win new business this year, which is really positioning the business well. Some critical things: the average relationships with our customers is 6 years. When we win customers, we keep them. And across our top 20, that tenure is 9 years. Why do customers stick? It comes back to that technology platform that we're delivering our service on is something that customers cannot access easily elsewhere in the market. Our customers, as Tim described, generally blue chip, large global corporate customers who value the sorts of service capabilities that we're bringing to market. The business continues to grow. When I led the MBO, we turned over 75-odd million, and we were losing some reasonable dollars. But to Daniel's point, and Daniel is one of our investors, John and I have significant skin in the game, and we are very keen to continue to drive our business as we look forward to continue the growth story that is Silk Logistics Holdings. Just to the next page, thanks, Tim. Just a bit of a breakdown of the segments. We talk about Silk in two parts. The port logistics operations that Tim talked to, which is really the movement to and from the port of containers. So we do as much export as we do import, and it's a very strong and growing part of our business. It gets us the hands on the freight ahead of our competitors. That part of the business has been where we've been acquiring. As we look forward to 22, we're now looking to acquire in our contract logistics business area. But both of these businesses, as you can see, continue to perform well. And certainly one of the key things for us as we look forward into 22, we picked up $46 million worth of new customer revenue in FY21. About 2/3 of that was reflected in our result in 21, and we're now pulling that through into our FY22 revenues, along with circa $15 odd million of revenue that we've won in these first couple of months of FY22. So I think the key for me, thanks Tim, the business with the model that we've got, that asset-light, agile operating model, we are able to adapt to the market, and we're navigating some of those challenges and have been doing so since the beginning of the pandemic in February last year. Our revenue and earnings continue to grow at rates that we think are as good as any in the market. Our asset-light model really allows us to bend the business relative to some of those disruptions. And we've seen instances such as MUA strikes, dislocation ex-China with shipping, which in a business that is heavy with assets, it is difficult to manage your workflow and your workforce and your assets and to remain cost competitive. In our business, we have the ability, given our asset-light model, to turn resources on and off relative to demand. And I think over the last 3 months, despite those challenges in our industry, our business is continuing to perform at or above our FY21 levels of performance. So we're a great believer in the business model and the technology that we're bringing to market. And we certainly see that being a critical aspect for FY22 and beyond. Just to touch on some of those other aspects coming out of COVID, there's obviously been a shift from what's been a traditional B2B market for us into more B2C. And as a business, we've had to contend with that and start to look to build B2C capability within our network. We're looking to fast track that with some acquisition, hopefully over the next 3 months in that space, given the demand we've got from customers who have traditionally been bricks and mortar B2B, really accelerating their penetration into that B2C environment. The other key point I'll probably call out is just labour. And I'm sure people will have talked about this, but there is a real war for talent. And good people are getting more and more difficult to find in what's been a challenging market, be that blue collar or in our white collar workforce. And certainly a key focus for us in FY22 is our employee value proposition and how we really refresh that to attract the very best talent available to us to continue to allow us to build the business as we move into FY22 and beyond. Just to close it out, thanks Tim, in terms of the last page. These are the numbers from our prospectus. I'm pleased to say we're tracking well in terms of these numbers, and indeed we're seeking to probably provide some trading update over the next 2 to 3 weeks relative to how we're tracking for this year. There is that uncertainty. It is around our business is coping well. We think we're working well with customers who are voting with their feet in terms of the model that we're bringing to market. And we're very confident that the Silk growth story will continue in the coming 12 months. Thanks, Tim.
Thanks, Brendan. You're in a really interesting space. Obviously, COVID's impacted. There's been a lot of inventory build-up. There's a lot of talk of blockages at the ports and COVID. Could you give us a little bit more colour on what that's meant and how you've had to manage that?
Yeah, look, very early days, Tim, there was an absolute exodus of inventory out of our sheds, and we got left with fresh air, which is not a great space to be when you're managing warehouses. What we've seen in response to that is customers are ordering well forward, and the old just-in-time principles in our industry have gone out the window. as customers look to secure inventory. So there's been a bit of that stockpiling occurring over the last 3 to 6 months. There is some dislocation at the moment with shipping, but we see a very strong next 2 to 3 months of shipping inbound into Australia, really addressing that situation.
And there's a question in regards to shipping here. Does your revenue correlate with shipping costs?
Now, look, ours is very much domestic, so our customers unfortunately do wear those shipping costs. Our job is to make sure we streamline the movement of those containers through their supply chain and get them back out the other end, so they're not adding demurrage to the pain of those shipping costs.
And another question, what sort of market penetration do you have, and therefore what sort of growth runway is over the next 5 to 10 years?
Yeah, look, we've done some work, and in those market segments that we play in, Tim, we think there's a contestable market there for us, circa $32 to $33 billion. So we think we've got significant runway for growth above our $350 million that we'll do this year.
And a question here in terms of how much penetration do you have with that existing customer in terms of that end-to-end logistics?
Yeah, look, when we started out, the central plank of our business was really our warehousing operations. 85% of our warehouse customers use 2 or 3 of our service lines. We're now focusing our share of wallet energy, particularly into the distribution space, where we see a really fertile sort of opportunity over the next 12 months. And
we always get a question on competition. What is your biggest competitive disadvantage compared to some of the bigger port and logistic operators?
Yeah, look, we don't really consider ourselves a disadvantage, Tim. We bring a different model to the market. It's very service focused. We're not chasing large volume and bulk volume, such as a cube might do. And we're very strong in the belief that our service focus and technology enabled delivery of that is really why we're continuing to grow double digit in our organic growth.
And can you give us a little bit more colour on the exclusive rights that you mentioned over the technology that you have in your business?
Yeah, look, the One Network platform is a US-based system. It's available to the Coles and large grocery guys, but as a 3PL operator here, we have the rights to operate that system and on-sell that system here in Australia. It's effectively a control tower platform. It is up there as number 1 or 2 in a global ranking, and it gives us that ability to bring disparate networks together and present them back to our customer as a single view of the truth.
And in terms of M&A, you spoke about that. Can you give us a little bit more colour on the verticals that you target? Does that come from the growth of online, for example, relative to bricks and mortar?
Yeah, look, certainly in the near term, we hope to secure an acquisition to really enhance our capability in that e-commerce fulfillment space. And then we're looking to expand our footprint in the port logistics space into West and South Australia, where we are suboptimal at the moment. So they're really our 2 focus points in the short to medium term.